If you're thinking about buying a house, you probably have questions like how much money do I need? What credit score do I need? And which loan should I choose? Today I'm going to keep it simple and talk about two of the common mortgage options, conventional and FHA loans. Generally, when you're getting ready to buy a house, lenders are going to look closely at three major things: your income, your credit, and your available funds for the transactions. First, what is a conventional loan? A conventional loan is a mortgage that is not insured or guaranteed by the federal government. It's offered through private lenders and is one of the common ways to finance a home. For credit, you commonly hear around 620 as a benchmark for certain conventional financings. But the actual requirements depend on the lender, loan program, and your overall financial profile. Some qualified buyers can put at least though at 3% down. If you put less than 20% down, you will typically have a PMI, private mortgage insurance. But here's the good news. PMI doesn't necessarily stay forever. Generally, you might be able to request PMI cancellation when your loan balance reaches 80% of the home's original value, subject to certain requirements. And PMI generally automatically terminate when the loan is scheduled to reach 78% of your home original value, as long as you meet the applicable requirements and are current on your payments. Now let's talk about FHA. FHA stands for Federal Housing Administration. An FHA loan is made by an FHA approved lender and insured by the federal government through FHA. FHA financing can offer more flexible qualification guidelines, particularly for buyers with lower credit score and smaller down payment. Generally, with a qualifying credit score of 580 or higher, you can put down as little as 3.5%. With a credit score between 500 to 579, FHA requires at least 10% down. Keep in mind that individual lenders may have their own additional requirements. Here's an important difference between FHA and conventional. If your FHA loan starts with more than 90% loan to value, such as typically like 2.5% down, the annual MIP or mortgage insurance premium remains for the life of the loan. If you starting your LTV is 90% or less, it means at least 10% down, the annual MIP lasts for 11 years. Some homeowners may later refinance from FHA into conventional to eliminate FHA mortgage insurance, but they would need to qualify at that time, and refinancing would need to make financial sense. Mortgage rates change constantly. Right now, you may see conventional rates somewhere in the mid to upper 6% range, and FHA rates potentially in the low to mid 6% range, depending on borrower and lender. But don't choose a loan simply because one advertised interest rate looks lower. You also need to compare mortgage insurance closing costs, monthly payment, cash to close, and total long-term cost of the loan. Your actual interest rate will depend on your credit, down payment, loan amount, points, property, lenders, and overall financial situation. Which one is better, conventional or FHA? There's no answer for everybody. You might have a great credit score but a small down payment. Another buyer might have more money saved but lower credit score. That's why every buyer needs to be evaluated case by case. If you are thinking about buying a house and you are not sure which loan is right for you, I would be happy to connect you with a loan originator who can review your income, your credit, your debt, available funds, and financial situation and help you understand what you might qualify for. Once you know your buying power and you pre-approve, it would be my pleasure to have you with the next step, finding the right home and guiding you through the buying process. My name is Tham Nguyen, Dallas Forward Realtor.